Hello everyone, and welcome again to Nettle, the best platform around for distance learning in business, finance, economics, and much more. Please don't forget to subscribe to our channel and click that bell notification button below so that you never miss fresh videos and tutorials you might be interested in. Many thanks to our current Patreon supporters and YouTube members for making this video possible, and we'd also greatly appreciate if you consider supporting us as well. So please check the link in the description or click the join button below for more details. My name is Sava, and today we have got an ambitious task on our hands: to build efficient portfolio frontiers using matrix algebra and real-world data in Python from scratch. So first of all, we need to import 4 distinct packages that would simplify our job tremendously. Those are NumPy, as in P, for arrays, Pandas, as PD for data frames, yfinance, as YF for real market data, and matplotlib.pyplot as PLT for graphs and visualizations. So we'll run this excerpt of code and download all 4 packages. Now let's import our data. First of all, we need a list of tickers, and let's consider 6 established US stocks from different sectors. For example, Boeing, the ticker BA, Citigroup, ticker C, Chevron, ticker CVX, Oracle, ticker ORCL, Pepsi, ticker PEP, and Pfizer, ticker PFE. Then we need to specify the start and end dates for our sample, and let's go 5 years, so from year-end 2015 until year-end 2020. And let's download our data. And obviously we could have gone for ticker and tickers and use a loop to populate a data frame of prices, for example, but I wanted to show you a simple trick that can simplify and streamline the code and make it more efficient. That has to do with the fact that Yahoo Finance does recognize strings of tickers separated by spaces. So actually, we can say that our prices data frame is a Yahoo Finance download function, and here instead of tickers or just one ticker, we need to input the join function of tickers, which would join the elements of our list, and at the start we need to specify how to join them. And as Yahoo Finance recognizes elements separated by spaces, we can input a space here in inverted commas. So that would deal with all of our data downloading in one go. And then we can specify the start and the end. And finally, we need to specify which price to use, and for robustness, to take into account dividend yield as well as capital gains, we'll get adjusted close. And then, as we have got our prices, we can calculate our returns day by day, name it returns data frame, and say that that could be prices data frame percentage change from day to day. And to get rid of the very first day, we can say that we're only interested from day 1 onwards, as obviously in Pandas you index your data frame rows from 0. So let's enforce this code. You can see that it has downloaded 6 out of 6 series at the same time, being more efficient. And to check that we've done everything correctly, we can return the prices data frame. Here we can see that our tickers are returned in alphabetical order. That's what happens when you use the join command and input it into Yahoo Finance. So keep that in mind when having ticker selections that are not alphabetically ordered. And in terms of our returns data frame, we would have 1 less observations, and we would have 1,258 daily returns for all 6 of our stocks. And given the fact that we've got no NAs, all of these stocks have been trading consistently across the 5-year period, we don't need to do any cleansing. If you need it, you could just drop NAs for the days. However, here we don't need to do anything like that. Finally, to define our problem, we can calculate our average historical annualized returns and our annualized covariances. So our return vector would be denoted R, and let's define it in terms of our annualized average historical returns. Obviously, we can go a little bit fancier, use CAPM for a market index and the beta of returns to determine the expected returns, but here we're keeping it very simple, meaning that we simply need to calculate the product of 1 plus our returns data frame, and there is a very efficient way of doing it in pandas, 1 plus returns df dot prod. That gives us the cumulative appreciation of our share price and the dividend yield over the course of 5 years. So basically what we need to do is we need to annualize it by raising it to the power of a fifth, as we've got 5 years worth of data here. Alternatively, you could do 252 divided by len returns df. That would annualize any length of data, given that there are 252 trading days in the year. So that is a more flexible way of doing that. And then you subtract 1 to get historical annualized returns. Then for the covariance matrix, we can use the cov function in pandas and say that we need to apply it to the returns data frame. So returns underscore df dot cov, and then we can annualize it straight away by multiplying by 252. To annualize covariance, we have to scale it linearly. And finally, for the matrix algebra reasons of the Merton matrix model, we also need E, a vector of ones of dimension equal to the number of stocks. So we can simply say np1s, a very handy function from NumPy that returns an array of length n populated with ones, and the length is obviously just len of the R array, which is the array of returns, or you could say len tickers, it doesn't really matter. So we enforce that, and then just to check that we are on the right track, our covariance matrix looks as follows. It's a 6 by 6 matrix with diagonal elements representing variances. It is symmetric with non-diagonal elements capturing all possible covariances between our assets. Whereas the R vector, the vector of returns, shows us how well did these stocks perform over the course of the 5-year period we've selected. All stocks returned positive figures. However, there is quite obvious underperformer, Chevron. The oil sector has been performing quite poorly recently and in the course of the most recent several years. Whereas Oracle, while being not the most successful tech company of all recently, did return the highest of the 6 stocks we considered. Now we have to use the vectors that we've just defined and the covariance matrix to define the investable universe as per the Merton matrix model. First of all, we need the inverse covariance matrix, ICOV, that can be calculated using the NumPy linear algebra, so NumPy linalg dot inverse, INV, of the covariance. Then, having calculated this, that would be a NumPy array of 6 by 6, as it is the same dimension as the input. This particular function does recognize pandas data frames as inputs, so it's pretty flexible overall. And then we just have to calculate the H vector and the G vector that correspond to the risk and return optimization facets of efficient portfolio frontier and modern portfolio theory. The H vector is the matrix multiplication result, NumPy matmul, of E, the vector of ones, and the inverse covariance. We can see that here we do not input any return-related data, just ones and risk-related data. So that's why H is quite instrumental in figuring out our minimum variance portfolio and overall optimizing your portfolio for very risk-averse investors. Whereas G is starting the same, but instead of E here, we input R, our vector of returns. And we are almost done with defining our investable universe. Here, we also need to input 4 constants that would define the efficient portfolio frontier, the quadratic relationship between variance and return. or the relationship between risk and return, if you're willing to take the square root of variance. A would be a scalar product of E and H, so we can actually save up some time and computational effort and just say it's a numpy sum of E times H, whereas B is the same with R instead of H. Actually, you could also say E times G. These two calculations would return you the same result, so use whatever you like. And for C, we do the same, but with R times G. And here you can see the nice symmetry of the portfolio frontier constants. This is a constant in return terms, simply because returns will not go into the calculation of A at any time. B is linear in returns, as H does not contain any return information, whereas R does. And C is quadratic in return, as R and G both contain the information on returns. So returns are multiplied on returns, effectively, given C is quadratic. And then D is just a scaling parameter, which is A times C minus B squared. And you can see quite nicely that D is quadratic, meaning that we subtract something quadratic from something still quadratic. And that is all we need to proceed with all of our calculations. We can just, to check whether everything works well, return the inverse covariance matrix we have calculated at the start of our code, and see that it's indeed a numpy 6x6 array that is, if we look at the element 1, 2 and the element 2, 1, symmetric, which means we haven't made a mistake anywhere. And then we can start looking at particular portfolios of interest. And in modern portfolio theory, the two portfolios of interest are obviously the minimum variance portfolio and the tangency portfolio. Minimum variance portfolio is the portfolio of risky assets only that has the smallest risk, which is the tip of your frontier. That's where your frontier starts, upwards from the MVP, MVP being minimum variance portfolio. And the tangency portfolio is the market portfolio in CAPM, and in theories leading up to CAPM, it is the point of tangency of the efficient portfolio frontier and the securities market line. And we'll plot the securities market line today as well as a very nice bonus. However, here we will keep it simple and do tangency portfolios with a 0 risk-free rate. So our risk-free asset is cash. If our risk-free rate is not 0, it's positive or perhaps even negative, the calculations are more complicated somewhat, but not by much. So if you're interested in a generalized calculation and construction of securities market line and CAPM derivation, let me know in the comments and we'll do that in one of our future videos. However, right now, let's do minimum variance and tangency portfolio. And these constants and vectors that define the investable universe actually define those remarkably well. Our MVP, the portfolio that is the weights that result in the minimum variance, is just the H vector divided by the A constant. And we can also calculate the MVP return and MVP risk in terms of these constants, return being B divided by A, and risk being 1 divided by A to the power of a half. So 1 divided by the square root of A, pretty much. And for the tangency portfolio, again, this is correct for a 0 risk-free rate. Non-zero risk-free rate would go into the calculation here. The tangency portfolio would be the G vector divided by the B constant. Those would give us the weights of the tangency portfolio. And then the tangency return and tangency risk can be again nicely expressed in terms of the constant, with tangency return being equal to C divided by B, and tangency risk being equal to C to the power of a half divided by B. And here we can already look at the weights of the MVP and the tangency. The minimum variance portfolio in terms of weights would be as follows. It would have a small short position in bowing and Citigroup, and positive positions in 4 other stocks. And that is actually a showcase of the limitations for Merton matrix model, as it assumes the investors are allowed to short sell as much as they want without any restrictions. However, in the real world, sometimes short selling is outright banned, sometimes there are considerable restrictions on it, practical or legal or otherwise. Some investors might just not be willing to short sell for risk-related reasons, and this particular restriction does complicate the derivation quite a bit. Overall, you need to know that the Merton matrix model assumes no restrictions or no limits on short selling whatsoever. So if you have high return targets, or if you are alright with taking large amounts of risk, you need to expect quite material short positions emerging in optimal portfolios. And for the tendency portfolio, if we return the weights, we'll see that it is quite a bit more concentrated still, with the 2 stocks with quite high return, which is Oracle and Pepsi, having very high weights, and considerable short positions in Citigroup and Chevron. And that's quite obvious, that is quite intuitive to understand, as these 2 stocks have among the lowest returns. So when return is prioritized to a greater extent than risk, short positions again become more prominent. Now we can plot the efficient portfolio frontier, and to start with, we have to consider a range of expected returns we're interested in, calculate the risk of efficient portfolios for these levels of return. So let's say that our expected returns are in NumPy a range from 0 until 0.2 inclusively, so 0.201. That is a very nice way of including 0.2, as NumPy a range is uninclusive of the very last bit in the range bounds. And let's go with a step of 0.001, so with a step of 10 basis points. That would make our curve, make our frontier reasonably smooth when we plot it. And then we can calculate our risk of the EPF by using the following function. The variance is quadratic in return, and that is equal to A times expected returns squared minus 2 times B times expected returns plus C divided by D. This does remind you perhaps of quadratic equations, and the very nice and insightful bit here is that C, which was quadratic in return to start with, we haven't multiplied by returns whatsoever, whereas B, which was linear in returns, we multiplied by returns to make it quadratic, and A, which was a constant and didn't have returns whatsoever, is multiplied by returns squared to make everything of similar power in terms of returns. And then, as this is the variance formula, we can move to standard deviation by raising it to the power of a half, or taking the square root, as you wish. And finally, we can use the PLT plot function to plot our risk and returns alongside each other. And it's customary to have risks on the x-axis, so we input risks first and expected returns second. And then we run the code and get our frontier plotted here. We see that our minimum variance portfolio is around 10%, and our frontier is sloping up quite fast, meaning that we are indeed getting some risk premium for taking on portfolio risk. However, to move up from 10% return to 20% return, we need to increase our risk exposure from around 18% to 30% annual volatility. And to see where the portfolios of interest lie on this frontier, we can simply introduce 2 scatters. Here, first we'll have the minimum variance portfolio, MVP risk, MVP return. That would produce the first scatter point, and then we'll scatter our tangency risk and tangency return. And that shows that first, these 2 portfolios do indeed lie on the frontier, which is good news, and the minimum variance portfolio does indeed have a return of around 10%. However, is the tangency portfolio really tangency, and how to visualize it? Well, here we'll plot the securities market line. Well, it turns out that it's very easy to do that when you know the constants and vectors that describe the investable universe, because the slope of the capital allocation line, or in this application the securities market line, is simply 1 divided by the square root of c, which means that per unit of return we would take that much risk. And that can be translated into the optimal Sharpe ratio being the reverse of that. However, we will not delve into these particular considerations here. What we only need to know is that SML risk, the risk of the securities market line, is equal to the expected returns multiplied by the SML slope. And here the calculations are again simpler, as we haven't got the risk-free rate. For risk-free rate present, it would be more complicated, but only just so. And having established the capital market line or securities market line here, we can introduce it on the plot. So alongside our efficient portfolio frontier, we also plot SML risk and expected returns. And that would give us the securities market line that we can easily see is tangent to the efficient portfolio frontier, exactly at the tangency portfolio point. And now, the final bit that we'll do before we call it a day is how to solve the problem of target return. That is, if you have got some return target and you want the portfolio with lowest risk that provides you with this or better return, turns out the same vectors and constants are instrumental at determining that efficiently. So let's start with the target return, and given the fact that we know the minimum variance return is around 10% and the tangency portfolio return is around 15%, let's go somewhere in between, like 12% annual target. And the first thing that you need to check is if the target return is below the minimum variance return, so MVP return, then actually we don't need to look any further, as the portfolios on the frontier with lower returns would have higher risks. So we would rather, if our return target is very small, like 5%, why not have both lower risk and higher returns? As this part of the curve, is actually not part of the efficient portfolio frontier, as the minimum variance portfolio does objectively beat all of these in terms of both risk and return, which means that any rational investor would prefer MVP to any of these. So it means that if our target return is less than MVP return, then our optimal portfolio is MVP, our optimal return is indeed the MVP return, and our optimal risk is MVP risk. Else, if our target return is greater than MVP return, so we are slightly ambitious, we need to figure out the point on the frontier that corresponds to that. And it turns out that we can define this problem as a combination of our minimum variance and tangency portfolios. And that's how we do it. First, we define two constants that are L and M. L would be the risk optimizing element, and M would be the return optimizing element. So L would weigh in the minimum variance portfolio and M would weigh in the tangency portfolio. L would be equal to C minus B times the target return divided by D, whereas M is equal to A times the target return minus B divided by D. There is some nice symmetry here and some bit of common sense as well. As our target return goes up, we want to weigh in less and less of the minimum variance portfolio and more of the tangency portfolio. Up to a point, we would short sell the minimum variance portfolio to get more of the tangency portfolio. And finally, our optimal portfolio can be expressed as L times H vector plus M times the G, plus M times the G vector. And obviously, optimal return can be calculated as the sum product of the optimal portfolio and the returns. So NumPy sum of optimal portfolio times returns. And the optimal risk can be easiest figured out by plotting the optimal return into the EPF formula that we have sorted out over here. Actually, this is a formula we can simply copy and substitute our expected returns with optimal return that we've just figured out. And finally, we can print what we have got on our hands. We can print our optimal portfolio, our optimal return, and our optimal risk. And if we run this code, we'll get our portfolio weights, our return, which is a rounded error away from 12% exactly, as well as the risk as per the efficient portfolio frontier. And what is nice is that we see the allocations that we seek to achieve to provide ourselves with the best portfolio given the assumptions that we've utilized that gives us a 12% target return. And still, we see how prominent short selling recommendations are from the MERT matrix model, and we might as well, at some future video, tackle quite a more complicated and less pretty way of constructing efficient portfolio frontiers with short selling constraints. However, that's a topic for another day, so please leave a like on this video if you found it helpful. In the comments below, I'm eager to see any further suggestions for business, finance, or economics videos that you'd like me to record. And please don't forget to subscribe to our channel and consider supporting us on Patreon. Thank you very much, and stay tuned.